re-optimize discretely. So in the 90s and early 2000s, work of this kind were present. So and the reason why that would happen is because of, if nothing else, mental adjustment costs of portfolios, and that seems to be helpful for your case.
Yes. So that is definitely one of the possibilities, like in the sense that, like a lot of these insurance companies, like there are some big ones, but there are a lot of them small ones, for example, and there is one guy at the head that has to make the decision, and the guy has a limited attention, right? Like, so every time he needs to make a decision, he has to
rational inattention will certainly do this, but even without rational attention, you would have a lot of other literature on at least discrete adjustments. And I should be able to find and send you a couple.
Yeah, that will be really nice. Especially empirical papers will be really nice. So because I mean, it is common in this literature that like even small adjustment costs can lead to long deviations from a target investment. But it will be good to be able to refer to other empirical papers that found some more like precise numbers, so that I can argue it in the calibration of the model if necessary.
I'll find that for you.
Awesome, thank you.
I'm also, can I just quickly ask something? Maybe this is not totally relevant what you're doing, but when you're, forming a portfolio, convexity becomes a big issue. So are you going to talk about that at all? I mean, do these insurance firms have, premiums for convexity? Are they happy to pay for it, or?
Actually, that's a good question. So I can talk about very briefly, like, we have mainly focused in the paper about the duration matching for the reason that the convexity of the insurance companies' portfolios are not regulated. Like when the regulator checks it looks at the duration matching of the assets and liabilities, right? And part of the reason is that like controlling convexity is a very difficult task, because if you want to control both duration and convexity, ideally, and even like if you control convexity, then there is a third order effect, fourth order effect, right? So you have to actually do a perfect cash flow matching, right? And this is like extremely difficult for insurance companies due to the unavailability of the bonds that would allow them perfectly match each cash flow, given the fact that like the cash flows are not always deterministic. I mean, because like in the we are in 2020, in the 1990s, who would have known that the life expectancy in the US was going to be like over 75 years old? Like maybe like there was going to be an environmental hazard and the life expectancy would have declined. So there are things that they cannot control, and therefore like matching for convexity is a particularly difficult task. But I completely agree with you. Like in an ideal world, they would have definitely should have definitely taken convexity into account. So about the paper, in the paper we have a static model, so that skirts the issue of convexity a little bit. There is going to be, but when I show you the model, we can still talk about how we are thinking about the possibility that convexity comes into play. All right. So, like I want to outline our empirical approach, and like we discussed earlier, insurance companies' risk is highly regulated, and most of their holdings is investment grade. So if I remember correctly, we hijacked this paper from hijacked this table from Becker Iwashina Journal of Finance paper that was published in 2015. So basically, if you look at the different rating categories for the bonds, corporate bonds, there are 6 NAIC rating categories. So the NAIC is the National Association of the Insurance Companies that deals with the regulation and data collection of about these insurance companies. And in the first category, which has the lowest capital charge, is the A-rated bonds and above. So these are like really top quality firms. And in the second one, in the second category, they had triple B rated firms. So these are the ones right above the speculative grade, like still good firms, investment grade firms, but lower quality than the others. And then the other speculative grade or high yield grade bonds are categorized in NAIC designations 3, 4, 5, and 6. And we will primarily focus on NAIC 1 and NAIC 2 categories. And why is that? Because most of the action for the insurance companies happens in those categories. If you look at these numbers, like it is 93% of their holdings are within these two categories. So there is very little action going on in the other categories. So this is also consistent with the earlier literature such as Becker and Iwashina. So remember that the premise of the first result that we were going to talk about was that there is a relationship between the interest rates and the yields of the bonds that the insurance companies are holding, in the sense that we argue that as the interest rates are lower, the insurance companies hold higher yield bonds, right? So, of course, when we say higher yield bonds, like there should be like relative to what, right? So there should be a comparison group. And in order to facilitate this, what we do is that we compare the yield on the corporate insurance company corporate bond holdings with the yield of the aggregate corporate bond portfolio in the same NAIC category. So like we calculate this excess yield, which is the yield, average yield on quarter end holdings in the insurance sector, minus the average yield of all bonds in the same NAIC category. Okay, so basically, if this number is positive, that is, if excess yield is positive, that means that insurance companies are holding those bonds that have higher yield relative to the market. Okay, and if it is negative, they are holding bonds that have lower yield relative to the market in the same category. All right.
So why only corporate bond yields? I mean, the other kind of risk that you can take, which you also talk about, of course, is duration risk, in a sense, right? And I can take that risk by corporates and by treasuries. So by moving from holding 2-year treasuries to 10-year treasuries, right? I'm still either reaching for yield or doing duration matching or something. So why only focus on corporate bonds?
Actually, we don't have it in the paper or on this slide, but what we ended up doing is that we also calculated their treasury holdings and like bunched basically all the corporate bonds and treasuries together, and the results that we have in the paper just follows through. So like nothing has changed. And the part of
I'm sorry. While answering, can you address to, is there any shift from treasuries to corporates? While maturities, am I also shifting from short-term treasuries to long-term corporates?
So that transitions don't happen strongly. The reason is that the risk-based capital ratios for these guys are different. So if it would be like a mutual fund, right, you would expect that mutual fund would easily rebalance their portfolio because, like when you look at even like the investment grade mutual fund prospectus, that doesn't mean that they have to put everything into investment grade bonds, right? Like they can take a little bit of non-investment grade, keep a little cash, keep a little treasury, and they have complete freedom in terms of allocating that stuff across different types of assets. In the case of the insurance companies, like they have strict capital requirements, so that they cannot cost us to simply like, oh, I'm gonna like purchase less treasuries and increase my corporate bond holdings because then they will have to hold more capital. So it doesn't come to them freely. So, but your point is well taken. And like I said, when we included treasuries into the mix and like pulled together with the NAIC 1 and NAIC 2 bonds, our results were very similar. And this was like not super surprising because the fraction of their holdings that are kept in treasuries is very little. Like at the insurance company, when you look at the general accounts.
Interfering, but Was that the case in the olden times when the treasury yields were high enough?
That's a good question. I think that in general, like the treasury holdings were not high, because the results that I say, our data, one advantage of our data is that it goes back to 1994.
Well,
so it's like we have a really long time series. So therefore, the fact that our results go through even like in such a long time series when we include treasuries suggests that, you know, like this was a common behavior. Of course, actually, now that you mention it, actually, it will be interesting to like divide the sample into two periods, you know, like where, you know, like you have high treasury rates, when you have low treasury rates, and see if there will be any difference in that. So that's a good point. I didn't think about that, but we can definitely look into it. Yeah. So we have primarily, again, part of the reason that we are following this particular method is that we want to be consistent with the previous literature, you know, like because like the seminal paper in this insurance company and corporate bond investment literature is the Becker-Ivashina paper. And what they ended up doing is that they ended up looking at within the NAIC1 and NAIC2 categories in order to control the risk-based capital. And they looked at how insurance companies have behaved in terms of the investment behavior within those categories. So we wanted to be consistent with their paper, and that is the primary reason why we are following the current empirical approach. It is not like we are married to this approach, so it is like pretty robust to understand. So far, does anyone else have any question regarding how this excess yield is calculated and what the purpose of it is? If not, like I continue. So what do we do? Like basically, once we calculate this excess yield, we check how this excess yield is related to the interest rates.
I'm going to stop you for a second. I'm sorry.
Of course.
This last sentence, this has the 10-year yield rate as the interest rate. This has nothing to do with your construction of the excess yield, right?
No. This is just like, basically, I'm going to show you plots where the y-axis is the excess yield, and the x-axis, I have to put some interest rate on the x-axis. And previous, like we started with the 1 year, but then like we were reading other papers, and it didn't make sense to use the 1 year because it is not the relevant horizon for the insurance companies. You know, like what do people do? They use 10 year, let's use 10 year. You know, like, I mean, again, like these choices are, like if we were the first paper in this literature, maybe we have made some slightly different choices, but we want to be like consistent with the previous literature. Yeah. Yeah. So based on this approach, the first fact is that insurance companies have increased the yield on their portfolio when interest rates are lower. So as you see here, there is a very strong negative relationship between insurance excess yield and 10-year treasuries, both within the NAIC1 category and NAIC2 category. And like the immediate response to that, immediate like feeling, the idea that this triggers is that, you know, like, oh, these guys are reaching for yield. Look, as interest rates go down, they have higher yield bonds on their books, so they must be taking risk, right? Because we are also comparing it with the other players in the market. However, like I said, an alternative channel might be that these guys are simply trying to do duration matching and of the assets and liabilities. And these two explanations have very different implications, because the first one says that insurance companies are bad guys, they are taking risks that they are not taking, so we should regulate them differently. And the second one says that they are actually good guys, they are trying to reduce their risk however they can, right? But from the perspective of an outsider, it might look like that they are taking unnecessary risks. So in order to dig deeper into this issue, what we do is that we calculate this thing called duration matched excess yield. So what is the duration matched excess yield? Basically, for every bond in the insurance company's books, we find 10 bonds that are closest in terms of its duration to these bonds, and take the difference between yield of the bond and the average yield of those 10 bonds. All right. So basically, like the reason that we are doing this is that, like it allows us to control any nonlinear relationship between the yields and duration. Because if you do the matching procedure, then you don't have to worry about the nonlinear relationships. And you don't have to worry about like changes in the price of duration risk, etc. Like because we do it at every period for every bond. And if you do this exercise, you see a very striking result, which is this duration matched excess yield is totally flat in its relationship with the interest rates. What does it say? This says that after controlling for duration, you do not get this negative relationship between the interest rates and the excess yields anymore in the NAIC1 category. If you look at the NAIC2 category, this relationship even slightly reverses. As you see, like this was like previously downward sloping, now it's slightly upward sloping. Of course, like one can argue that, this exercise, you inadvertently also capture something about credit risk, for example. Like what you are capturing is not only duration risk. So in order to address that concern, we also do the same thing for the credit risk. So basically, we are calculating the credit risk matched excess yield, and we do it in different ways. So here in this picture, you see the distance to default matched excess yields. We also do the same thing with the credit default swaps. The reason that we have primarily used distance to default is that because the data is available for a longer time period, whereas credit default swaps are available like starting early 2000s. And for those of you who are not familiar with this corporate finance literature, distance to default is basically like how far away the firm is from its default boundary. And it is basically negatively correlated with the probability of default of a firm, essentially.
I have a question. This is not something that needs to be answered now. I could have asked this anytime, so I'm going to do it now, but postpone as you like. So this whole thing depends on the interest sensitivity of the duration in insurance firm or of insurance firms' balance sheets, right? Now, if you ask me this question, how would the bondholding behavior of firms that have interest-sensitive balance sheets will change, right? I actually wouldn't have thought of looking at insurance firms. I would have looked at mortgage originators and banks in particular who hold a lot of mortgages and mortgage-backed securities, because those things have notoriously interest-sensitive durations. And one of the things that, at least as central bankers we know, is their duration matching is a huge force in the bond markets. So the question, but what is nice there is that is asymmetric, because when interest rates begin to go up, essentially nothing happens. When they begin to go down, people begin to prepay and duration falls like a rock, right? And so looking at those firms and their behavior in the bond market in this regard, and in particular, whether it is asymmetric with regard to the interest rates, seems to be a very strong verification of your conjecture.
Actually, that's a very good point, and I'm going to come to those options when I motivate the simple model in the future. And let's get back to that question after that, because the options, the reason that there is a negative relationship between there's a positive relationship between there's a negative relationship between the duration of liabilities and the interest rate is exactly these embedded options in the life insurance contracts.
All right, there you
go. And you are like literally way ahead of me. Like I'll talk about it in a minute. Yes.
Okay.
You are perfectly right. You are on the same page. What I want to show here is just that after we control for the credit risk, there is like some little reduction in the negative relationship between the excess yields and interest rates at the NAIC1 category. However, if you look at the NAIC2 category, like the relationship even is a little bit stronger. So we are comparing the original orange dot with the blue dots. like therefore, like in the NIC2 designation, this suggests that like they're actually maybe even taking slightly higher credit risk, slightly lower credit risk as the interest rates decline. Okay, so what we do in this slide is, like I said, it is the same exercise, but instead of using the distance default, we have credit default swap rate matched excess yield. And overall, like this negative relationship between excess yields and the interest rate do not disappear after controlling for credit risk using CDS. So what is the corollary of these facts? So far we have been talking about yields, right? But you might ask me questions like, like the yield is price of risk times quantity of risk, right? So how do I know that these are actually taking an extra quantity of risk? Maybe it is simply that the price of risk has changed over time, right? And that is why we are observing these results. So, and the direct way of looking at this is calculating excess duration defined in a way that is similar to excess yield, which is the duration of the holdings of the insurance companies. And when I say here average, I'm talking about the weighted average. So, like you should think of it literally like the duration of the whole, all corporate bonds, valuated corporate bonds in the insurance companies' balance sheets. And take the difference of it from the average duration in the same category. So here we are particularly looking into the investment grade universe, right? And as you see that the excess duration of the insurance companies are increasing as the interest rates are declining, all right? So essentially, as the interest rates go lower, the duration of the insurance company's balance sheet are higher and higher relative to the rest of the market, all right? And if you look at do the same exercise for the credit risk, you do not see that negative relationship anymore, right? So basically what this picture is telling us is that even when you look at the quantities, you see the same result, that insurance companies take on duration risk or buy extra higher duration bonds as the interest rates decline. Whereas if you look at the credit risk, they do not see that they are taking on extra credit risk. Okay, so that cannot be the main driver of the negative relationship between excess yields and interest rates. So, so this is the summary of these results, and especially the fact that they do not take on higher credit risk when interest rate decline seems to be at odds with the idea of reaching for yield, right? Because if you are an insurance company who wants to reach for yield, right, and given the fact that you have a menu of options regarding how you can reach for yield by taking on different risks, like you could choose like you can take on some duration risk on your plate, but you would definitely take on some credit risk on your plate too. There is no reason not to load on credit risk if you are if reaching for yield is your main goal. Okay, and therefore, we're thinking about an alternative story, and there is this recent paper by Domarsky and Shushko that is talking about a dynamic hedging of the insurance companies' assets and liabilities through duration matching. And for those of you who are not familiar with the idea of the duration matching, so let me give you like a brief textbook review of the issue. And if you have any questions, something is not clear, please feel free to interrupt me at any time. So basically, duration matching starts with this accounting identity. So basically, the duration of assets can be written as leverage times duration of liabilities plus the share of equity times the duration of equity. Okay, so this is an accounting identity between of the duration of assets, leverage, and duration of liability and duration of equity. All right, and the textbook definition of the duration gap is the difference between the duration of the assets minus leverage times the duration of liability. And as you see, like from the accounting identity, you know, like this definition of the duration gap is very closely related to the duration of equity. All right. Like, by the way, like I realized that I didn't define duration because I assumed everybody would know what it is. But duration is essentially like in the simplest terms, you can think of it of sensitivity of corporate bond to the value of a corporate bond to interest rate. So if the bond value is more sensitive to interest rates, then you would call that bond a higher duration bond. The insurance company's objective is keep this duration gap as close as possible to zero to immunize equity against interest rate changes, right? So in other words, you know, like they want to keep the gap or equivalent duration of equity as close as possible to zero. And what are their incentives to do so? First of all, there are regulatory reasons. You know, like if there is a mismatch between the duration of the assets and liabilities, then they have to have higher risk-based. They have to hold more capital due to the RBC requirements. And the second thing is that their riskiness, because the duration is directly related with the interest rate risk, right? The riskiness of the insurance companies affect the demand for their products. And because of that, they have both regulatory and business reasons to keep the duration gap as close as possible to zero. All right. So, but now that we have this relationship, and we can immediately test this idea by the Domansky, Shin, and Shishko, that whether these guys are indeed keeping the duration of equity equal to zero, right? Because if they are doing perfect duration matching, perfect hedging, the duration of equity should be always zero. And we can calculate the duration of equity actually very simply using this regression that we like. Again, this is textbook Campbell-Low-McKinley regression, where on the left-hand side we put the return on equity, right, for the insurance equity index, and on the right-hand side we can look at we put the changes in yields, and basically if they are perfectly immunizing the equity values against the fluctuations in interest rate, what we should see it is that the coefficient of this variable, the change in yield variable, which gives us the duration of equity, should be equal to zero, right? And this is very simple to test. You know, like you run the regression, you look at the results. Oops, like the coefficient is not zero, right? So that means that there is like not perfect duration matching going on if you look at the equity of the insurance companies. So in order to understand, you know, like why do we not find this perfect duration matching despite the fact that they have strong incentives to do so, we do a 2-year rolling estimate of this equity duration coefficient. And what we find is that, you know, if we do like this 2-year rolling estimate, there are indeed periods where the duration of equity is very close to zero, but there are also periods where the duration of equity deviates from zero for extended periods of time, okay? And so when I was thinking to myself, you know, like, I mean, why would this happen that like you see like extended periods of deviation? I immediately started thinking about like 10 years ago when I was writing my PhD thesis, you know, like we would have these models about investment adjustment costs. And as you know, like if you have adjustment costs in like if you have a firm and if you cannot change your capital immediately, either because there are fixed costs or time to build concerns, etc., there might be long periods where you can be away from your standard neoclassical investment rule, right? You know, like normally, ideally, if there are no frictions, you would always want to invest according to standard neoclassical investment rule. But because of the frictions, like investment adjustment cost, you can deviate from that target for extended period of time. And we are essentially what we are doing in the rest of the paper is applying this logic to the portfolio choice of the insurance companies in a very, very like simplistic way.
I know, John. I guess one thing that would help here is to think that these are large players, right? They are not atomistic holders of debt. And therefore, the entire literature on financial market intermediation will suggest that they will try to do things in a smooth fashion over time, because they will not want it to be known that this behemoth is in the market trying to buy or sell. And that literature clearly exists, right? The literature on dealer brokers. And I guess if nothing else, you are clearly able to cite that saying, large players in markets of asymmetric information have the correct incentive to do their business in small increments so as not to reveal their identity and not to turn the market against themselves. And that by itself will get you this partial adjustment.
1 second, let me write this down. Reveal info slowly. Okay, so actually that's a very, very good point. So in the next couple of slides, we are going to actually look at the large versus small insurance companies separately. And so there, the reason that we were looking at the large versus small insurance company was due to price pressure. In the sense that if you are a large insurance company and you want to make same amount of duration adjustment to your portfolio as a small insurance company, you would actually need to engage in a larger trade, which will generate a larger price pressure, which will be more costly for you. So, and we were thinking about it, like we were thinking about the price pressure without thinking of a particular mechanism. But, like, for example, we can think of the mechanism that you suggested exactly like as one of the reasons why there will be price pressure, like, I mean, if you, like, because even if they do not know who the counterparty is, like, for example, a large insurance company buys like a large amount of bonds, right? And because they want to do the duration matching and the other guys don't know who the counterparty is, the fact that somebody places a very large trade will automatically tell them, oh, somebody knows something that I don't know, right? And then it starts putting price pressure. Or there might be simply like a downward sloping supply, so upward sloping supply curve and stuff like that. So, but what you suggested is one of the reasons that we implicitly had in mind, I guess, but we didn't say this in the paper. So thank you for the suggestion.
A quick question.
I just wanted. Sorry, go ahead.
No, it's fine. Go ahead if you want.
No, my question is very short. Okay, so
I'm sorry.
I just want. So okay, go ahead then. I'll ask next.
So have you taken a look whether if these insurance companies behave like a preferred habitat kind of agents? Do they operate in certain certain durations versus certain yields and certain assets of some sort?
Actually, that's a very good question. We were talking about. I was talking to Refet about this. We have another paper that sort of touches onto the preferred habitat thing. But within the context of the paper, like this explains why the insurance companies hold very long duration bonds, right? Like because if they didn't have such long duration assets, right? They wouldn't need to do such long. They wouldn't need to hold such long duration bonds. Like for example, if you look at the property casualty companies, I haven't done this analysis in detail, but my inkling would be that the duration of the bonds that they are holding will be much shorter than the life insurance companies, because those guys are, like, I mean, when you buy auto insurance, right? You buy it for 1 year, so like the property casualty companies therefore don't have long horizons in terms of their liabilities. Like every year you renew your auto insurance, you renew your homeowner insurance, right? Like if, for example, it were the case that like they are saying that we are selling 30-year long homeowner insurance or something like that, right? Then maybe they would have also preferred longer term bonds, but unfortunately, it's not the case in the market because nobody lives at the same home for 30 years, right? Like, I mean, especially in the US, like everybody moves like on average every 5 to 7 years. So, and there was one more question, sorry.
So my question is simple. So looking at the figure, I kept thinking about 2008-9 crisis and AIG going bust. A lot of insurance companies holding CDS and things maybe they shouldn't be holding. and I say following the crisis,
so around here, you mean, right?
Yeah, so the mismatch closes and the climb up happens around then.
Yeah, so here, like, things is like, this is like, I think this is like right around Lehman, right?
And NAIG.
Yes, so these things, I mean, we haven't completely focused on this period, right? And this is kind of difficult to interpret because even like when you look at our, like, for example, the excess yield result, right? So there is this outlier here that is like smiling at us, like everything is lined up very nicely on a straight line. And here there is this outlier. So this is also the Lehman event, like this part that Lehman went belly up. So it is therefore interpreting the asset prices and how they relate to interest rate right around the Lehman crisis is kind of difficult. So
but my point is the climb up seems to start around then.
Oh, you mean like, why did it climb up? Because the long-term interest rates have been declining like crazy because of the LSAPs and stuff, right? So actually, that's exactly the point that I want to make in this graph here. And actually, that is what this note is about. So basically, like the lower interest rates, like here we say recent years because we started the paper a couple of years ago, but right after the crisis, the lower long-term interest rate actually may have pushed the insurers towards this climb up of the duration of equity. So because this is minus duration of equity, so there's a negative climb up, right? You know, like there is a decline in the duration of equity. And the logic here is that because of the duration of liabilities change with interest rate due to the implicit options in the insurance contract. So this goes back to what Refet was talking about earlier. Because what happens is that, so all these insurance contracts have some predetermined withdrawal or surrender value. So basically, if you think that you can get a better deal outside of your current insurance contract, for example, if the treasury rates are super high, right, then you can just like break your insurance contract, get the surrender value of that insurance contract and invest it to some treasury, for example, or something that has higher yield outside of your contract, right? So what happened after the crisis is that the interest rate, especially long-term interest rate, has started going down like crazy, right? So what does it mean? That these surrender and withdrawal rates have declined, and I'm going to show direct evidence on that. So basically, because the withdrawal surrender rates have declined, it means that the insurance companies who were expecting to distribute some money due to the surrender of the contracts now have to make those payments further into the future. Because what is the effect of surrendering a contract? A liability that you were supposed to pay in the future, you have to pay today, right? So what does it mean if people surrender less? It means that the liability duration has increased, right? So basically, if the interest rate increase, right, then people surrender more, which means that your duration of liabilities decrease. If the interest rate decrease, the opposite happens. People are less likely to surrender, and therefore the duration of liabilities will increase. Okay, and this increase in the duration of liabilities will cause a downward pressure on the duration of equity, because remember, the duration of equity is essentially the difference of duration of assets and duration of liabilities. So there is a push up in the duration of liabilities due to the lower interest rate environment, which means that the duration of equity, the duration of equity should decline. And that is indeed what happened. The duration of equity declines because this is the negative duration of equity, right?
Okay.
Yeah. So what we are saying is exactly like the reason that I'm showing this picture, actually, you know, like it is completely consistent with our story. Of course, like what we see here is that, you know, like after a couple of years, it started coming down. Maybe we should update this picture, I think, by a couple of more years, because now we have more data. But like it started coming down, and this is also consistent with that, you know, like they want to go back towards zero, right? But it takes quite a long time. Why? Because the interest rates have been declining over and over. You know, like it is like a horse race, right? You know, like, I mean, the interest rate decline, your duration of liabilities increase. Therefore, you want to increase the duration of your assets. However, interest rate continues to decline, so that you are chasing a moving target, right? And so how fast you will catch that target will depend on how large your adjustment costs are and how fast that target is moving, right? And so, like I said, this pattern seems to be consistent with the partial adjustment framework. So, for example, like the reason for the partial adjustment might be like market frictions, such as like the management costs that we have talked about, or transaction costs, or the price pressure created by large trades, or because the unwillingness of large insurance companies not to reveal the information they have to the other market participants. Like I said, like the continuing decline in the interest rates always furthers this gap, further widens this gap by decreasing the duration of the liabilities, and it creates a time-varying target for the duration of assets of the insurance companies. And for those of you who are not familiar with the macro literature, because I was talking about the investment adjustment cost, but for those of you who are more inclined, who are more knowledgeable about corporate finance literature, you can think of it like there is this like quite long literature about time-varying target leverage ratio that is like regarding how the corporations make their capital structure decisions. And the logic is very simple, like in the absence of any frictions, the insurance company, the firms would like to have exactly a particular target leverage ratio, but they cannot attain it at every period due to frictions, right? And here, like instead of the target leverage ratio, think of it that we have a target duration. It is the same logic exactly. And taking that, taking that as given, we come up with a simple model of duration matching with adjustment costs. By the way, are there any questions so far? Like regarding the intuition that I'm presenting. So, one thing that I forgot to mention is that like this option is the option of the related to the duration of liability is similar to the prepayment option in the context of mortgages and banks. So that is going back to Refet's earlier point. So here, like we start with a simple model of duration matching with adjustment costs, and this model has two components. So what my goal here is that to start with a simple model and then calculate the first order conditions of the model, and then show you how this first order conditions of the model implies a simple linear equation that we can estimate using a reduced form approach. So like it is like sort of like a middle ground between a structural estimation and reduced form estimation. I could just like directly throw at a reduced form model and then tell you that believe this is the right model to run. But instead of doing that, I just wanted to start with a simple model to justify to motivate the specification of the reduced form econometric model. So this model has two components. Essentially, like the main purpose of the insurance company is to minimize its costs. And these costs have two components. One of them is costs due to carrying a non-zero duration gap for reasons that I have mentioned earlier. And the other one is the cost of trading to adjust duration. All right. So basically, if your duration gap is different from zero, then you incur some costs. And if you want to change your duration of assets more, which means that you have to trade more, then you incur larger costs. All right. And you can think of these parameters as the relative importance of the cost of having a non-zero duration gap. So that is a function of the regulatory costs or how much business you will lose if you have a positive duration gap. It's like about how costly it is for you to make these trades to adjust your duration. All right. to simplify this model a little bit so that we can take the first order condition, I would like to remind you the definition of the duration gap that we discussed earlier, which is the difference between the duration of assets minus leverage times duration of liabilities. All right. And then we define this leverage times duration of liabilities as the target duration. Okay. Why do we define it as the target duration? Because if the insurance company chooses its portfolio so that the duration of assets is equal to this term here, this second term, you can see my arrow, by the way, right? So because I'm pointing to stop with the arrow, but I want to make sure that people see my arrow. Okay. So, and because the duration gap will be equal to 0 if the insurance company chooses its portfolio so that the duration of assets is equal to leverage times duration of liabilities, we call this leverage times duration of liabilities as the target duration of the insurance company. All right. And furthermore, we decompose the duration of the assets of the insurance company into two components. And the reason that we are looking at this is that because we are interested in the investment behavior of the insurance companies. That is how the insurance company changes in duration by buying and selling assets, right? And therefore, we want to know how much of this change of the change in the duration of the assets of the insurance companies is due to an active investment behavior rather than for exogenous reasons. Like, for example, as you know, like when the interest rates change, right, or as time passes by, the duration of assets, the duration of corporate bonds can change, even if the insurance company doesn't make any changes in its portfolio, right? You know, like, I mean, in the simplest case, like if you keep the same amount of portfolio, just because one quarter has passed, what will happen is that the duration of your portfolio will decrease by almost one quarter, right? Even if you do not do anything. So, but what we want to know it is that, you know, like we want to know like the changes in that duration due to the active investment behavior of the insurance companies. All right.
Good question.
Go ahead. Sorry.
Okay. So your loss function implicitly or explicitly assumes that target duration gap is 0, but that might not be because duration in the I mean, you know, these institutions might have views on the path of interest rates too, and might be taking positions on that path via their duration gaps. So if they have time varying target duration gaps, would the implications be different?
So let me think of it step by step. So if they have, like if insurance companies have different duration gaps, but it is fixed over time, but it is cross-sectionally different, right? Then our regressions will take care of it because of the company-specific fixed effect. Because in the first order condition, it is just like appears as a company-specific fixed effect. When there is time variation within the same insurance company, then the question becomes, why is that duration gap target time varying? Right? So, and because you are right, then because there will be one-to-one relationship, actually, like you can immediately see it from that, from this set of regressions. Basically, what we are suggesting is that you are putting this next to GT, it will be GT minus G star T. You know, like basically, like you get punished for the deviations from your target duration that might be time varying. Right. Target duration that might be time varying. So, and it would appear here in the last equation in this first parenthesis. So that will be like dA star minus GT star, right? So basically, it will be exactly the same model, the same first order condition, but the target duration would be adjusted by the amount of the target duration gap, so to say. So basically that will be like a slight modification of the first order conditions. So let me actually talk about the first order condition. So, okay, it says my internet connection is unstable. Can you still hear me and see the screen?
You
Okay.
froze briefly, but you're okay now.
Okay, cool. So basically, like in order to basically put everything together, we put these definitions into the objective function, and then we will get this. We will end up with this single objective function, where the only thing that we need to maximize is the active change in duration of the assets. All right. So, and when you take the first order condition of this thing, we will end up with this particular equation. Okay. And basically, the only difference between introducing a non-zero duration gap target would be simply like adjusting this term here by that time varying duration gap amount, essentially. And this first order condition, there seems to be too much notation, but it is like extremely intuitive. So the left-hand side is the change in active duration, all right? And the right-hand side is the difference between the duration of the legacy assets. What this means is that what will be the duration of the asset of this insurance company be if the insurance company does not engage in any sort of duration adjustment, okay? Minus the duration of the target duration of the assets, all right? And what is the intuition? The greater the distance, the difference between the duration of legacy assets and the target duration is, the faster you change your duration. So, for example, the duration of the assets that you carried over from the previous period is much larger than the duration target that you want to achieve, meaning that this is a very, very large positive number. That means that because of this negative sign, you trade in order to actively change your duration in the negative direction, so that the difference between the duration of assets and the target duration gets smaller, all right? And to top it off, the speed of adjustment of this change in duration depends on this coefficient. And what is this coefficient? This coefficient simply captures the relative cost of having a non-zero duration gap to cost of adjusting the duration through active trading. Okay, so I see some confused faces, so please tell me where I have lost you so that I can repeat that part. So, let me. So did I lose you here or here? So let me ask this so I can repeat that part.
So let me ask you a quick question. Convexity is an issue only when you have very long-term assets. So what types of durations are we talking about?
Oh, this is like, I mean, I don't remember off the top of my head, but like 7-8 years at least, I think.
Is that 7-8 year duration off of a 10-year security or a 7-8 year duration off of a 30-year security? And convexity.
Oh, okay. So this is I'm talking about the duration of their holdings.
Okay.
So,
no, so the question I'm asking is this: if I'm going to worry about convexity, okay, but the longest maturity is around 10 years, then I'm not really going to worry about convexity. Convexity kicks in, much later than that, right? So the question here is, are these, and you're looking at corporate bonds, which I don't know as much about. So are there corporate bonds that have, 20, 30, 50-year maturities? Are these common things?
There are, but they are not common. Like very large blue chip companies like IBM, etc. They have some like 30-year bonds, right? But they are really not that common. Actually, let me take one step back. So there is no reason that we should basically get stuck in this argument here. So here I just I'm confusing a little bit. I'm really sorry about that. So I do not need this non-zero convexity argument in order for anything in the paper to be operational. All right?
Can I stop you for a second? I guess the reason why the question I'm really asking is this. You have two mechanisms that can generate the same effect. One is convexity, one is the options. Okay?
Yes.
But these are different in the sense that convexity is symmetric. It works symmetrically when interest rates go up and down, whereas the options are not. Okay? As long as the option isn't exactly at the money, right? The option is asymmetric. So which effect do I expect to see dominate so that I could ask, whether we should see the asymmetric effects and whatnot?
So, okay, so this is a good point. So, first of all, I agree that the options are asymmetric, but if you think of it for an individual person, it is asymmetric, right? But if you think of the group of people, like everybody who holds a life insurance with that particular company, right? What matters is the surrender rate, right? And that surrender rate is typically a continuous variable in the interest rates.
Hang on. I don't know this language. Yeah. What is the surrender rate?
The surrender rate is the fraction of people who withdraw their money from the insurance company, basically who break their contracts, right? Okay. So for an individual person, I completely agree that there is an asymmetry there, right? Because this, by the way, that asymmetry is a little bit less in some insurance products because some insurance products have this property of paying options, meaning that you can actually increase your insurance premium willingly in order to get a greater benefit using the same contract terms. So therefore, like the option is not always necessarily one-sided, but even then, even if it were one-sided at the individual level, if you think of at the company level, which has hundreds of thousands of people insured, right? That the relationship between the surrender rate and interest rate, basically the fraction of people who withdraw their contracts, that is going to be relatively continuous variable. You see what I'm saying?
Okay.
So therefore, that asymmetry that we are just talking about might not be super relevant at the company level, although at the individual level it might be relevant. So that's what I want to say. Like for those two reasons, we haven't looked at the asymmetries, like both because at the company level it might be less relevant, also because there are paying options that it is sort of like it's like a two-sided option. It's not super common, but it exists. Yeah.
Okay.
So I mean that's my answer essentially. But I see your point. Under different circumstances, we would have expected there is a asymmetry between interest rate increases and decreases. All right.
Actually, hang on. Help me out again. Why is there the option to begin with? What is the insurance contract like to begin with?
Okay, so basically, if you think of the basically a whole life insurance contract, right? What they say is that you pay me this much premium, right? For this many years, for 30 years, and if you die by the time your contract is done, then I'm gonna pay your family this much money.
Okay.
So, and That's essentially what the insurance contract is. But what happens is that as you pay this premia, right, you end up accumulating a cash value of the insurance contract. So basically, sorry, I take it back. I said it wrong. There is a cash value of the insurance contract that is part of the contract that says that, you know, like if you would like to break your contract and instead like take your money and invest it in somewhere else, you can do this, but this is how much money you are going to get.
Okay, so basically, this is a particular kind of life insurance, right? In Turkish, that's called birikimli, because you're not just paying an insurance premium, you're also having almost a deposit-like account with the insurance firm.
Yes, yes.
Because if you know, I have this. If I die, my daughter gets paid. If I don't die, then at the end of the period, the part that is actually paid as an insurance premium is subtracted. On the rest, I receive principal plus some investment return. There are these type of contract as well. You know, like okay. So I guess my question here is, why do I want to withdraw this when interest rates fall?
No. You don't want to withdraw it. That's exactly the point. Because you don't want to withdraw it, the payments that the insurance company are going to make are going to be farther into the future, and that is exactly why the duration of liabilities are increasing.
Okay, I asked the question badly. Why does my withdrawal behavior correlate with interest rates anyway? Let's say interest rates went up. Okay, the return on my portfolio in the insurance firm should also have gone up.
If the contract specifically says that, you know, like I'm gonna give you treasury rate plus X%, for example, then that is the case. But that is not always the case. That is what I'm trying to say. So, and if these were indexed funds, right, then you are completely right. Actually, like there is going to be too much digression, but there are even sometimes like some guarantees attached to these cash component of the insurance contract, but these are like more complicated products, which they say that I'm going to give you like some number around like some stock index or some interest rate, but that number is not going to fall below a certain level. Like I'm going to give you minimum like 2% every year, right? So it's like a annuity, like variable annuity with a guarantee attached to the same life insurance contract. So, and in that cases, for example, if the interest rates are near zero, right, you know that if you keep your money in the insurance company, you will get 2%. So therefore, you will continue keeping it at the insurance company, for example, right? But I'm just like complicating stuff. It is just like what I'm trying to say is that there are like many different things that the insurance companies have, and there are many reasons why the interest rate affects this surrender behavior.
But the point here is, at least some of these accounts behave as if they are demand deposits, non-interest bearing demand deposits. So when interest rates go up, I have an incentive to withdraw my money and put it to better use.
Exactly. I mean, you can definitely think of it like that. And the way that there are penalties in like having those long-term deposits in the bank when you want to take it before the maturity, right? You have to pay some penalty for this case. Okay. So how much time do I have left? So I might need to skip some slides according to like 15 minutes.
15 minutes.
Okay. Basically, this is the first order condition of the problem. And this animal here, like the legacy duration of the assets, we can directly calculate it. So, it will be a function of the interest rate, but for the purposes of the regressions, we don't need to worry about that because we can directly calculate it from the data. Because the exact holdings of the assets of the insurance companies from the last quarter. And then you can calculate the exact duration of the assets of the insurance companies if it was the case that they didn't change anything in their portfolio. All right. So the tricky part of this regression will be the target duration of the assets, because as we have just discussed, the target duration of the assets is a function of leverage and the duration of liability. So it is not simply equal to the duration of liability. It is leverage times the duration of liability. All right. Because of the so the bad thing about the good thing about the insurance company data is that we have very detailed information on the asset side. The bad thing about the insurance company data is that we know very little about the liability side. So in order to circumvent this obstacle, we are going to make the assumption that the duration of liabilities are a linear function of the interest rate. Okay, so and just like place this into the first order conditions directly, and then test the implications of the model to see if the model gives results, if the data gives results consistent with the model. And so what happens is that basically we call the left-hand side the active duration adjustment, right? This is like literally that you do the adjustment that you do to your duration willingly. And then we have as the right-hand side variable the legacy duration, which we can calculate directly from the data. Again, legacy duration is the duration of your assets from the previous period today, if you did not make any changes to your portfolio. And leverage times a linear function of the interest rates. Okay, so again, my connection is unstable. Can you guys hear me?
Go on.
Okay, so and once we put everything together, this gives us a linear reduced form regression that we can run, where the variables are legacy duration, leverage, and the interaction of the leverage with the interest rates. All right. So, and if you look at this, again, this is the regression that we will run. Left-hand side active duration adjustment, the right-hand side legacy duration, leverage, and leverage interacted with interest rate. For completeness, because it's very common in the linear regression, if you have uninteracted terms, you put, if you have interactive terms, you put uninteracted terms as well. We also put this interest rate alone on its own. And the model has a very, very strong predictions regarding what these coefficients should be. All right. Like the first prediction is that the coefficient of the legacy duration should be a negative number between 0 and 1, 0 and minus 1. Okay. The coefficient of leverage should be a positive number, and it is like a related with the with the speed of adjustment again. But most importantly, the coefficient of the legacy duration directly gives us the speed of adjustment. And then the coefficient of the leverage times interest rate should be a negative number. All right. Why is it a negative number? Remember, the duration of liabilities are given A plus B times R. And because there's a negative relationship between the duration of liabilities and interest rate, we expect this B to be negative, right? Because we expect this B to be negative, we expect the coefficient of leverage times interest rate to be negative. So this is another prediction of the model. And the coefficient of the standalone interest rate should be 0. Why is that? Because if you look at the model and if you look at this equation, the equation we have written in here, normally there should not be any interest rate in this equation, right? I have just put the interest rate in that equation in the regression just to complete the model. If the model is correct, the coefficient of this should be equal to 0. That is, the interest rate will affect the duration adjustment only through its interaction with leverage. All right?
Can you remind me the measure for the interest rate? Is it so?
It's 10-year. It's 10-year.
Okay.
Yes. So, and what we do it is that, like, in case like I cannot go through every result, I'm going to show you the numbers, but in case I can't go through everything, so what we do is that we confirm these 4 predictions in the data, right? And then we do further refinement and find that the larger insurance companies adjust their portfolio more slowly. Remember, the coefficient of the legacy duration was giving us the speed of adjustment, right? And this number is different for larger insurance companies in a way that suggests that they adjust their portfolio more slowly. And another thing that we do it is that, like the transaction cost might be another source of the adjustment cost, right? And we found that the insurance companies with less liquid portfolios adjust their portfolio more slowly as well. So this is also consistent with the adjustment cost mechanism. All right. And then as a further test for the mechanism, we provide direct evidence that the surrender lapse behavior are consistent with the mechanism. And then we have further predictions regarding the model implied equity duration and compare it with the equity duration in the data. Okay, so I'm going to try to go over them as fast as I can, but again, we have about probably 10 minutes, so I might not go through everything. I might not be able to go through everything. So again, to confirm these empirical predictions in the data, we simply run the regression both using both the book leverage and market leverage, and you see like across the board the same result. The coefficient of legacy duration, which is related to the speed of adjustment, is negative and significant. The coefficient of leverage is positive and significant. The coefficient of leverage times interest rate is negative and significant, all right? And the coefficient of the 10-year yield is insignificant. So all of these are consistent with the 4 predictions of the model. And this is the comparison of the large versus small firms and liquid and those with illiquid and liquid portfolios. So I'm just going to skip this. So here is like a quick test of the policyholder behavior, because remember that the mechanism was that interest rate affects the policyholder behavior, which in turn affects the duration of liability, which in turn affects the duration of the assets, right? So there is like a couple of steps that goes from the interest rate to duration of the assets, right? So therefore, instead of like running this regression that we have been running so far, we run a 2-step regression. In the first step, we put the surrender ratio on the left-hand side and the interest rate on the right-hand side. And in the second regression, which replaces our main regression, we use this predicted surrender ratio that comes from the first step and check the coefficient of that variable. All right. So what we expect is that this coefficient to be positive, higher interest rate, higher surrender ratio. Okay. And this coefficient of the surrender ratio to be negative, like higher surrender ratio, lower active duration adjustment. All right. And here is like a quick bird's eye view for the whole insurance market. Like if you look at the surrender rate in the aggregate insurance market and 10-year treasury yield, there's a very strong positive relationship, right? Huge R square. If you look at the lapse rate, which is an alternative way that you can wind down your insurance contract, there's also very strong positive relationship. All right. So, and for example, exactly when we use the surrender ratio, we exactly see this positive relationship between surrender ratio and 10-year yields, and the negative relationship between the surrender ratio and active duration adjustment. It's exactly the predicted mechanism in the model. The same thing with the lapse ratio. So I'm going to skip this. And okay, this is the final slide. There are some other robustness checks in the paper as well, but I'm going to stop after this slide, which is like, remember that we have made the model is super stylized, right? Like, I mean, it is probably the simplest models I have ever created in a paper in my life, right? So there are a lot of assumptions in the model, right? And one of these strong assumptions is that there is a linear relationship between the duration of liabilities and interest rates, right? Like, does it have to be linear? Is it a reasonable assumption? How do we know, right? We don't observe the duration of liabilities, okay? Although we do not observe the duration of liabilities, what we observe actually, like we have discussed towards the very beginning, the duration of equity, okay? So therefore, what I can do is that I can use the model's coefficients in order to estimate the duration of the equity for each insurance company at each time period, right? And check this model implied duration of equity with the duration of equity that we can calculate directly. How can we calculate the duration of equity directly? Remember earlier I have shown you this regression where we put the return on equity on the left-hand side and duration of equity on the right-hand side, right? So using this regression, I can calculate the duration of equity for each insurance company directly, right? So then I have also the duration of equity that comes from the model. Why? Because I know the total asset value, equity value. I can calculate the model implied duration gap. From there, I can find the model implied duration of equity. All right. So then the testing if the model is sensible is a quite simple exercise. We ran a similar regression that we did before with the return on equity. However, we interact the right-hand side variable, the change in yield, with the duration of equity. If our estimate of the duration of equity that comes from the model directly, for which we have not used any equity data, if you remember, then we should see a coefficient of 1 here, right? Because that means that duration of equity is so well measured that this coefficient should be equal to 1. If the duration of equity is measured with like a large error, etc., this is going to be like more close to 0, right? Because of the measurement error or because the model is bad. All right. And what we find is that we get an estimate of beta that is 1.13 with a standard error around 0.4. Like, I mean, we were like extremely excited when we have seen this, you know, like because like I was thinking that, you know, like we will probably like miss the target a little bit because the model is extremely stylized and had to make some adjustment to the model. But it was like beautiful in terms of like how close we get to the number of 1, essentially. Let me summarize this. Like I think I have like 1 minute or 2 minutes left. What we show is that insurance companies seem to increase the duration of their assets in response to lower interest rates, but not their credit risk, right? And so, like looking at different parts of the data, we concluded that the evidence seems to be consistent with a duration matching story under partial adjustment costs. So I want to say something very important here, though, which is related with the financial stability concern. So typically, when we talk about this investment behavior of the financial institutions and how the monetary policy should be changed in order to address those issues, financial stability issues, the usual conclusion is that if you increase interest rates, so lower interest rate creates wrong incentives for the financial institutions to increase their risk, which creates a financial stability concern in case of bad shocks, right? Therefore, we should increase the interest rates in order to make these companies more stable, right? So this is the immediate financial stability implication of ideas that are related to reaching for yield, right? However, and now like I'm coming up with this argument telling you that, you know, like these guys are actually good guys. They are not trying to increase their risk. To the contrary, they are trying to reduce their risk, right? But from that, you should not conclude that, oh, you know, like everything is safe. We don't have to worry about anything because these guys are actually trying to minimize their risk. Because the fact that there are adjustment costs brings another financial stability concern. In the sense that, as we have seen in the picture before, like the time varying duration of equity picture, the insurance companies can deviate from a zero duration gap for extended periods of time, right? And how the Federal Reserve's interest rate policy will affect the health and stability of these life insurance companies will depend on whether the insurance companies have a positive or negative duration gap at the time of the monetary policy decision. So therefore, we cannot always say that, oh, you should increase interest rate if you want to create financial stability, or you should like lowering interest rate increases financial instability, right? So it really depends on the duration gap position of the investors. Yeah,
I have a deeply stupid question. Something. So once you hear the question, I must be misthinking something, but I can see what. So other than just mechanically matching duration, this seems like a particularly risky and dumb trade, which it shouldn't be. So I'm asking you, what am I missing? In the following sense, interest rates fall a lot. So I understand that I'm going to call them depositors, insurees, right, aren't going to withdraw their money, so my assets duration has gone up. Therefore, I go out and buy a boatload of 30-year corporate debt, right, at low interest rates, meaning high prices. Okay. Now, okay, what is the covariance structure that I'm looking at? In what way am I hedged? Because say, a year from now, interest rates go through the roof. Okay. So asset duration falls, and actually people are asking for their money back. So this option is being exercised, and people are saying, I'm liquidating the assets now, right? So give me back my money. So I have to sell these bonds now, and I have to sell them exactly in the state of the world where interest rates are high and their prices are very low. And this has to be killing me. So why am I doing this dumb trade?
Oh, okay. So I agree with you. There is always that danger. And I mean, there is somewhere in there another paper idea that we should talk about more. That's a very, very good point. I completely agree with you. To your point, the reason that you have to do it is that, first of all, because of regulations. Like, right. You cannot simply say that, what you are suggesting is that the regulators should be more flexible and take that into account when punishing insurance companies for duration mismatch, right? Because sometimes a little bit duration mismatch might be good for the insurance company because it will not suffer too much when the interest rates increase, right? So I completely agree with that.
Yeah. So focusing on duration here misses a much more important dimension of risk and hedging activity that these firms should be involved in.
Yeah, that's a very good point. So let me mention something else here. Like, there are other options for the insurance companies to hedge their interest rate risk. So they can buy swaps. And until after the financial crisis, like around 2009, etc., until 2009, they have engaged in very, very little swap activities, and because of the regulations. And after 2009, they started to increase their swap activities, right? But it is still not enough to cover all their exposure completely. So therefore, there is something going on that doesn't make them want to cover their interest rate bets against this type of shocks that you have mentioned, and I am not 100% sure why that is the case. Before 2009, I can say that, there were the regulations were they were regulations about market to market stuff, etc., that made the interest rate hedging through derivatives very costly for them, right? After that, some of these regulations have been relaxed, and we have seen a large increase in their interest rate swap usage, etc., like derivative usage, but it's still not enough to cover their whole position. And why? I do not know the answer at that point. That's exactly why I'm saying that there is like a paper somewhere in there, because I completely agree that these things are always squeezing the toothpaste in the tube, right? If you squeeze one thing, you create a problem somewhere else always, right? And I'm sure that what you are suggesting
view of regulation.
Yeah, because what do you do if you try to squeeze the whole tube? Then the whole thing explodes, right? And I think that whatever we do in terms of regulation, it always has unintentional consequences that we do not see until the next crisis. I completely agree. What you are saying is a very, very interesting thing. And I think it should be a topic of a paper.
All right. Well, I'm glad that I hadn't entirely missed it then. Thank you.
Are there any other questions, guys? I know we are a little over time. I'm sorry about that.
So this give them credit for, right? Because not even the reaching for yields might be reaching for yields. So that's good to know. Yeah. And I have to say, excellent presentation. Thank you for that. On something that I knew nothing about, I got educated at a rapid pace.
Thank you so much. Thank you. Thank you for your comments. And
it remains the case that we had talked about you physically visiting, and then it, obviously didn't happen. But this is not a substitute. So whenever the world is reasonably normal, we do expect to see you here.
I'll take you up on that offer. Thank you very much.
Yeah. Excellent. Very good. You have a good day starting with breakfast, and people here have a good evening.
Okay.
Thank you.
Enjoy your evening, everyone. Take care. Stay safe.